What if I told you that right now, as you're watching this video, your bank is quietly stealing your money without you knowing it? Not through taxes, not through visible fees, but through a secret system so normalized that you probably don't even notice it happening. This secret theft system is called fractional reserve banking, the financial world's greatest magic trick, where banks literally create money out of nowhere. So, let's get deep into it. Part 1. What is fractional reserve banking? Fractional reserve banking is a system where banks only keep a fraction of your deposit on hand and lend out the rest to other people. You worked hard all month, earned $1,000, and decided to be responsible by putting it in your bank. Good job, right? But here's what they don't tell you at the friendly neighborhood bank branch. The moment you deposit that money, your bank only keeps about 10% of that money. Yes, only 10%. This means that out of your deposited $1,000, they kept only $100 and loaned out $900 to someone else, while still telling you that your money is safe. Your full $1,000 is available whenever you want it. Wait, what? That's right. Your bank is essentially promising the same money to two different people at the same time. It's like lending your car to a friend while telling you it's still parked in your garage, ready whenever you need it. But that's just the beginning of an infinite loop. Part 2. The infinite loop. Do you recall the $900 that was loaned out by the bank to someone else? After borrowing it, the borrower pays another person to purchase a gadget, a car, or anything else, and that person deposits the money in their bank. Now that second bank takes that $900, keeps $90, only 10% in reserve, and loans out the remaining $810 to someone else. This process repeats again and again and again. It's the financial version of Inception. Money is being created from money that never really existed. By the time this cycle finishes, your original $1,000 deposit has magically transformed into $10,000 circulating in the economy. That means $9,000 created completely out of thin air. And that's how the banks keep creating and multiplying money. According to recent financial reserve analyses from late 2024, this monetary multiplication effect has expanded the US money supply by over $21 trillion, money that simply didn't exist before banks created it through loans. But here's the catch, this isn't even illegal. It's literally how our entire banking system is designed to work. Part 3. Who created this system, and who wins from it? Let's look at the brief history of fractional reserve banking. This system really took shape in 1668 with Sweden's Riksbank. And fast forward to 1913, the US stepped in with the Federal Reserve Act, setting up the Federal Reserve Bank. And that's how the system became a big deal in America too. So, why does this system even exist? Well, it technically helps the economy grow. Let's find out how. More loans is more spending, is more businesses, is more jobs. Sounds great, right? Except for something you won't expect. This system also leads to massive debt, inflation, and banks swimming in power. Let's check how. Banks profit off loans. More loans is more interest is more money for them. Meanwhile, you're stuck with 0.01% interest on your savings. Banks win, and you lose. That's why governments and central banks truly love this system, because it helps them keep money flowing and people spending. In an ideal world, the money used for risky, long-term investments would only come from people who actually choose to put their money into those kinds of investments. That's the idea behind something called narrow banking. But with our current system, which is fractional reserve banking, pretty much everyone's bank deposits are used this way, whether they know it or not. And here's where it gets tricky. Most people have no idea that just by putting money into a regular bank account, they're participating in a big financial strategy designed to solve what economists call a collective action problem. In plain terms, your money helps fund stuff like mortgages, startups, or business loans, whether or not you meant for it to. Now, weirdly enough, this seems like a genius fraud because it has actually worked out pretty well for society. It's helped fund a lot of productive things like homes, innovation, and economic growth. Of course, there have been some major missteps, like the big financial meltdown in 2008, which was largely triggered by the collapse of the US housing market. It led to a severe recession worldwide, bank failures, and significant economic disruption. The real problem shows up when this whole system is the only legal option. Banks like Custodia and the Narrow Bank wanted to offer people a safer alternative, places to stash your money without it being lent out. But they've been blocked or restricted. That's an issue. Because when fractional reserve banking fails, it doesn't just cause small ripples, it can blow up the whole economy. Now you're probably thinking, okay, but how does this actually steal from me? Part 4. Why you keep getting poorer while banks profit. The answer is inflation. Now, if you're not totally sure what inflation means, don't worry, you're not alone. Inflation is when the prices of things like groceries, rent, and gas go up over time. But here's the catch. Your money doesn't automatically grow with those prices. So even if you have the same amount of cash, it buys you less stuff. When banks create money out of nothing, they're diluting the value of every dollar you already have. This means more money is suddenly floating around in the economy without more goods or services being produced, which makes each dollar less valuable. That's the truth of inflation. Imagine you ordered a pizza with 8 slices, and suddenly someone adds 8 more people to share it, but you didn't get a bigger pizza. Now each person gets a smaller piece. That's what happens to your money. It gets thinner and thinner. The average American will earn somewhere between $1.5 million to $2.7 million in their lifetime. Sounds like a lot, right? But thanks to inflation, caused in large part by this banking system, it's estimated that up to $1 million of your hard-earned money loses its value before you ever get to enjoy it. $1 million. Gone. That's like earning it, and then watching it quietly vanish over time. Isn't it like a vampire effect, slowly bleeding your wealth, not in one dramatic heist, but penny by penny, day after day, for your entire life? And the banks? They just kept on making loans, because more loans equals more profit for them. Part 5. The risk nobody talks about, a bank run. But surely this system must be super stable if everyone's using it, right? The answer is no. Imagine what happens when everyone wants their money back at the same time. That's called a bank run, and it's the nightmare scenario for any fractional reserve system. Let me tell you about Silicon Valley Bank's collapse in 2023 in Santa Clara, California. It all happened pretty fast, and suddenly, one of the big banks in the tech world just wasn't anymore. It was a complete meltdown in just 48 hours. Because people lost trust, yanked their money, and poof, the bank ran out of cash. They simply didn't have enough reserves to cover all the withdrawals. Or look at the 2008 financial crisis, a very bad economic downturn around the world, which began with the fall of the US housing market and got worse when lenders were careless and banks failed. These weren't accidents. They were the inevitable result of a system built on promises it can't keep. It's like they're playing high-stakes poker with your money, and you're the last to know. The reality is that the average bank today holds just enough cash to handle about 10 to 15% of customers asking for their money at once. So, if just 1 in every 5 customers showed up demanding their cash tomorrow, the entire system might collapse. You know, that's exactly why we've got things like the FDIC, the Federal Deposit Insurance Corporation. Basically, the FDIC is there to keep things stable and make sure people trust the financial system here in the US. One of the big things they do is insure your deposits up to at least $250,000 per person for each type of account you have at any bank that's insured by them. It's almost like the government saying, okay, yeah, this whole financial thing can be a bit shaky, so we've got your back if things go south. But the FDIC only has enough funds to cover about 1.3% of all insured deposits in the US. One major banking crisis, and those promises become very hollow very quickly. Part 6. The hidden dangers. Well, this wasn't always how banking worked. Back in the day, banks were basically secure storage facilities. If you deposited one gold coin, they kept that exact gold coin safe, and you could come get it whenever you wanted. But some crafty 17th century goldsmiths realized they could make more money by lending out receipts for gold they didn't actually have. As long as everyone didn't want their gold at the same time, nobody would notice. Fast forward to today, and this temporary solution has become our entire financial system. What was once considered fraud is now taught in economics textbooks as normal business. As Robert Kiyosaki, author of the book Rich Dad Poor Dad, bluntly puts it, fractional reserve banking is nothing but legalized theft. Kiyosaki has repeatedly warned his millions of followers that this system is the biggest scam in history, allowing banks to essentially counterfeit money legally while the average person's savings get silently eroded. In his 2024 interviews, Kiyosaki emphasized that understanding fractional reserve banking is the key to understanding why savers are losers in today's economy. He points out that when you save cash in a bank, you're essentially funding the very system that's devaluing your money through inflation. He says made-up numbers and not-so-great leaders end up taking away your money and your freedom. He added that when they mess with the value of money, it hurts the whole economy and makes people lose control over their own finances. Part 7. What you can actually do about it. So what can you do about this hidden wealth drain? Here's the truth. You can't change the system, but you can stop letting it walk all over you. First, understand it. The system thrives on confusion and complexity. Now you know how banks don't just store money, they manufacture it out of your deposits. This knowledge is your first line of financial self-defense. Second, don't rely on savings accounts to build wealth. Hard assets that can't be inflated away, like certain commodities, real estate in growing areas, and yes, even some cryptocurrencies like Bitcoin that have fixed supplies. These are all potential shields against the fractional reserve vampire. Third, invest in assets, things that grow or generate income. That could mean stocks, real estate, starting your own business, or even understanding how to use debt smartly, the same way the rich do. Don't just work for money, make money work for you. Because while the banks are out there turning your $1,000 into a castle of debt, you could be building your empire. The truth is, fractional reserve banking isn't some grand conspiracy. It's just a system that benefits those who create and receive the new money first, at the expense of everyone else's purchasing power. So next time you walk past a shiny bank building, remember, they don't just store money, they manufacture it out of yours. It's not just sketchy, it's a legalized illusion. But now you know the trick. If you found this explanation helpful, hit subscribe for more financial truths they don't teach in school. Because knowledge isn't just power, it's financial self-defense. Thanks for watching. See you in the next one.